Good afternoon. Following up on last week's Point Zero forum in Zurich, hosted by Elevandi, I must say very well, a very well-run conference, very high-level participation, and some very interesting discussions were had all the way through, whether those were at the round tables, in the networking areas, or in the presentation rooms. Some of the things that I felt came out of it as key thematics, the focus was between AI and ESG, which for some reason people didn't quite get the connection that ESG is being thoroughly undermined by the adoption of large language models, but let's put that to one side. Blockchain, payments, and central bank digital currencies, CBDCs. The last three, of course, are the ones that we're really interested in. And the things that came out of that I thought were very interesting. Number one, what we're seeing emerge is this idea of a global layer one. And it's not just global layer one itself, which is a project run by Alan Lam at the Monetary Authority of Singapore. It's the thing that this is signposting, and that is that big institutions are very much on board with how we need to adopt blockchain, that it is something that is definitely part of our future economy, but equally that they are deeply frustrated with the failure of the existing blockchain industry to actually come up with a solution that is an actual blockchain that actually works, which is precisely what we're doing with the 𝐏𝐨𝐢𝐬𝐧. So of course, that was particularly interesting for us. But because of that frustration, they're now starting to form consortia, much like MasterCard, Visa, and so on, that will begin to say, well, if you're not going to do it properly and seriously, then we'll do it, which really undermines a lot of what we thought that blockchain was going to be about at the outset, that it was this public open resource that nobody owned, nobody controlled. And I think the industry itself has a lot to answer for in terms of spending 90 billion on a lot of faff and nonsense and not actually taking anything forward seriously. There are, of course, some good projects out there, but remarkably few. Out of a $90 billion spend, remarkably few. The second thing is this whole idea of CBDCs. A lot of what we've seen about CBDCs has been a mishmash of definitions prior to this, and the juxtaposition of stablecoins versus CBDCs as well. How we define a CBDC is very much up in the air. How it's going to be enacted, affected, and how it'll be applied in different jurisdictions is also different. So these were another pieces of the puzzle that fell out of it. And I had some really interesting conversations and presentations I heard from Kwame Apang, who is the Director of FinTech and Innovation at the Bank of Ghana. And Ghana, for me, is the shining hope for Africa generally, but specifically West Africa. I think it's got enormous potential to be a leader in that context. Wolfram Siedemann from 𝐏𝐸 and Different Currency Technology in Germany. He's actually working on CBDCs, and he made the point really well during the conference, I felt, supported by the Peter Kirstens from the European Commission on this, which was quite difficult for me to have to think that I agreed so strongly with somebody from the European Commission. But they were both advocating this point that a CBDC should be as cash-like as possible, that we should respect the anonymity of cash, which I thought was very interesting because a lot of the conversations about CBDCs have really been about how they will become a control mechanism. And then Ian Woolford from the Reserve Bank of New Zealand was another very interesting conversation to have, who was very open about the need for innovation in the context of payment systems in New Zealand. And what I wanted to bring this back to with you was to examine, because I think you speak brilliantly about how the very structure of the 𝐏𝐨𝐢𝐬𝐧 answers so much of what these people are looking for and asking for. And specifically when it comes to associate chains, how their implementation and the features that they enable and provide actually fits directly to this and the realities of the world in which we find ourselves.
Yeah, so I think, going back to what is the promise of blockchain to begin with, blockchain technology is the decentralized, permissionless nature of traditional blockchains like Bitcoin. And so one of the things that we have been putting a lot of energy into is to figure out how this could be fitted into the existing structures that we have. Because I think this has been one of the bigger disconnects between the blockchain space and traditional finance. That if you build a completely permissionless blockchain, this also means that it sits outside of any regulation, which is very hard to pair with local legislation, local financial policies, which are necessary for a well-working economy. And so what we have done to try to solve this is to partition the problem so that we are sticking to, say, traditional blockchain basics in the central blockchain, which we call the Mint, which operates as a central bank essentially for the universal permissionless currency 𝐏𝐨𝐢𝐬 or 𝐏𝐏𝐤, and then allowing other operators to create associate chains in this system that are compatible with that speak 𝐏𝐏𝐤 natively. But one of the things that we haven't pushed so much, perhaps, is that you could also run a native currency on your associate chain. And on this associate chain, you can adapt consensus to comply with your local regulation. For example, you could have trusted actors like your national banks running the chain to make sure that what happens on that chain is essentially adapted to your own jurisdiction, your own enforcement mechanisms, and that you have your own control levers. And also in many countries, especially countries that are natural economic areas, you can expect to have a local currency because it makes absolute sense. And in order to be able to jack into a system like that, you really need to separate the permissionless from the permissioned part, the regulated from the non-regulated part. And a proper way to view the 𝐏𝐏𝐤 in a permissioned associate chain that runs a national currency, basically, I think would be to see it as a foreign currency.
Yep.
And the slightly weird thing that we've had historically is that if there is a global currency, it's typically the local currency of the big gorilla on the global scene that becomes the de facto global currency. And right now, we've been in an era where that's been the US dollar. That dominance is now being contested, in a sense. And I think this is actually the area where you would like to, where we think we see the greatest potential in decentralized currency technology, that where we think the 𝐏𝐏𝐤 actually meets the requirements for a neutral, permissionless, universally acceptable currency.
And the 𝐏𝐴 itself provides the framework for all of that to operate seamlessly and without any bridges. So you don't have that interoperability issue that we see in the existing blockchain infrastructure offerings and how they interact with one another. And certainly in each jurisdiction, even within supranational jurisdictions like the EU and indeed the US, you still have states in the US, you have countries in Europe who have their own regulatory frameworks and may want to have their own regulatory payments infrastructure, etc. A couple of things that fall out of that I'd like to pick up with you. One is, how might an associate chain facilitate somebody saying, I want to create a gold-backed currency, for example. That's the first. The second is, how can we accommodate very high-speed transactions at very, very low cost if you were to really provide a payment solution set? And the third is, to what extent can we argue that actually the 𝐏𝐨𝐲𝐬 and the services that are built into it, in effect, provide each country, each jurisdiction, each industry with a turnkey solution to having a complete payments infrastructure? Because we also have that capacity to utilize QR codes at point of sale in order to facilitate transactions with mobile phones. And then the fourth point would be to look at cash. Because one of the points that the Central Bank of Ghana or the Bank of Ghana made very well, and also Wolfram Seidman made well, is this need for the CBDC itself to be represented in a cash form.
So, yeah, if you're running a regulated permission chain, having a digital currency that is instantiated and actually backed by some material value becomes a lot easier because you actually have regulatory force behind it. It is more difficult to do this in the permissionless space, obviously. Now, we also want to push the idea that in order to be a universal working currency, you actually have to have the characteristics, transaction characteristics needed for something to be a usable currency, so that you can actually, you have low fees. The key to low fees is you have high throughput. And also for a global scale, the way we structure the system, you can actually offload the central chain with associate chains that work as associates to the mint and actually allow you to localize traffic and multiply the throughput so that we can keep fees low. We also have low response times, short response times, so that you can actually get acknowledgement within seconds from the chain, which is a really important aspect if you want to be able to do online purchases or even in-store purchases where you have a line building up behind you. You don't want to stand there and wait for an hour for final confirmation, obviously, but you actually want useful confirmation within seconds. Now, we also have state channels as technology, which offer privacy because you basically go off chain with part of your funds and transact in real time with another party. And then you can close up the resulting balances to the chain. So the individual transactions actually do not have to become part of the fully transparent ledger on the public chain. Now with state channels, we can actually do millisecond level response times and scaling linearly so that you could actually handle, for example, real-time payments in a busy subway system, even in a metropolis, and with actual finality, not having to have a major actor putting up collateral to make sure that someone absorbs the risks, because you have to shortcut all the security checks, which you would normally have on your credit card, for example, because they're not designed to move that fast. So we can actually do that down to real micropayments within fractions of a second, essentially internet scale if you want to. So we have that capacity technologically, but one of the keys that we don't see many of our competitors really dealing with is the ownership. if you're going to run a central bank, national central bank digital currency, it's really important that the country is able to own that chain and control the rules on that chain. The requirement that we impose is that it is 𝐏𝐨𝐢 compatible, so that the 𝐏𝐨𝐢 currency is viable as a native currency on that chain. But you can have another native currency that is also viable.
Yeah, to your point that it's a foreign exchange facilitation, it's a foreign currency, and it's a facilitator to go to other foreign currencies in the same way that the USD has been historically. Thank you very much indeed for your time, and thank you all for watching.